Our next panel is the moderator is Steve Looney. Steve is the chair of our tax department at Dean Meade. Steve just returned from Southern Federal, where he made a presentation and is probably one of the most prominent S corporation experts in the country. And Steve comes to us from the Show Me State. He has his JD from Missouri and his tax degree from the University of Florida. And I'll turn over the tax presentation to Steve.
Thank you, Michael. I guess we have a fairly challenging task of keeping you all interested in covering tax planning and tax controversy issues in an amazing 30-minute period. So we're going to be pretty much talking about these issues at the 30,000-foot level. I want to go ahead and introduce my panel. To my immediate right, I have David Paparod. He is a tax manager with RSM McGladrey here in Orlando, a couple of floors up from our offices. Next to him is my partner, Jane Callahan. She is a tax attorney and does a lot of tax controversy work. And then on my far right, I have Jesse Little. He is with Wells Fargo in their Boca office, and he is a wealth planning strategist, a senior wealth planning strategist, at Wells Fargo. So with that, I'm going to go ahead and turn it over. We have a number of topics to hit. As I said, it's going to be a kind of 30,000-foot level, but I'm going to turn it over to David.
Good morning, everyone. I'm going to talk about the domestic production, activity deduction, a little bonus depreciation, and where's that going, a little bit on energy tax issues and incentives, just so you guys are aware of what's going on, and then some tax rates. The domestic production activities deduction has been around for several years. Most of you have probably heard of it. And I know some of you are taking advantage of it. It's for qualifying production activity, whether you're manufacturing, producing, growing, or extracting a product. So most of the agricultural activity qualifies. A packing house is an example that would not qualify. They're not growing, extracting, or anything. They're just taking the fruit and packing it and sending it on out. This deduction is 9% of your qualified production activity income, or the lesser of your taxable income. And one of the other limits is 50% of the W-2 wages. Most of you may be members in cooperatives. Cooperatives take huge advantage of the domestic production activity deduction, and some cooperatives pass that deduction through their members. When it's passed through the members on your 1099 PATR, there is no limitation on it. There's no taxable income limitation, there's no wage limitation on it. It's just a straight deduction to the member. So if you guys are members of cooperatives and you aren't taking advantage of it or aren't aware of what the cooperative's doing, make sure you ask and see. I mean, the cooperative can use the deduction, pass it through, or split it. I mean, can use some of the deduction and pass it through. Bonus depreciation. For this year, for 2011, there's 100% bonus depreciation for asset acquisitions, for capital asset improvements, meaning the taxpayer can write off 100% of the cost. There's no limitation. It just has to be a qualifying property, basically anything that you can depreciate 20 years or less.
So David, as you said, there is no dollar limitation on the amount that you can take.
No, and as
Very
long as
important.
if you invest $1 million in capital improvements and equipment and machinery, you can write off that whole $1 million, create a loss, and either carry the loss forward, or you can carry the loss back and recoup some taxes. Right now, for 2012, it goes back to 50% for next year. There are discussions in the administration's plan, the new tax plan, to extend this to 2012. So just be aware. And bonus depreciation, one key part is the asset has to be new. It can't be a used piece of equipment. This is some highlights of tax credits for energy incentives. Some of my clients that have land that don't want to get back into agriculture or don't want to replant citrus trees, they kind of explored whether they want to put up solar panels and so you have this In your handouts, it just goes through the different credits. There's production credits and investment credits. And the rest of these slides kind of go into a little bit more detail on the energy tax credits. And states and federal governments have programs that can help with those energy equipment. I don't want to spend a whole lot of time on these, but you do also, here's a list of energy incentives, some credits that may apply to the agriculture community, some fuel credits, some biodiesel. Probably one that's may hit most of you is this agricultural chemical security credit, where if you're paying to put up security for your chemicals, you get a credit for it, whether it's the fence, cameras, a lock, you can get credits for that. So and there's some limitations on, I'll back up one. There's some limitation on the chemical security credit. And this last one I want to bring your attention to, your income tax rates. And these are the rates for the married filing jointly right now for individuals. I think it's very important to understand where you're going individually, where business is going, because I know most of you have pass-through entities, and how's that going to affect the ownership. Their income in 2011, here's the rates. For income after 2012 and 2013, basically the 10% rate goes away. So now you have the 15%, the 28, 31, 36, and 39.6%, the way things stand now, if the administration doesn't change and Congress doesn't change anything. So my advice to my clients is we plan for what we know and then adjust from there. Also part of what's supposed to sunset, part of the Bush tax cuts is the capital gains rates, go to 15 to 20%. Qualified dividends goes to, that benefit of 15% goes away and is taxed at your ordinary rate. And then also you have the 3.8 Medicare tax on net investments for the health care.
So potentially the top tax rate on dividends can go from 15% to 39.6%, which is really dramatic.
Directly, yes. And that's all I have.
All right, first of all, I should have pointed out earlier, our materials are in a separate folder, this blue folder. Our outline is in there, so if you want to pull that out, I apologize for not telling you that earlier. I'm going to speak for just a few minutes on choice of entity, how your business should be operated in what form. But before I get into that, and it's kind of a lead-in, it's kind of a follow-up on what David was talking about with tax rates, because tax rates certainly affect choice of entity. And what we've heard, or at least some commentators have said, with the increase that's scheduled for 213, as David said, and it's been scheduled for a number of times. You never know what Congress is going to do. But if that happens, it's going to be the first time in a long number of years that the maximum marginal individual rate will exceed the maximum rate on C corporations. Well, a number of commentators have suggested that might lead to some kind of resurgence of C corporations. My take on that is no, it won't, unless the tax reform, I don't know how you heard Charlie last night speaking on tax reform. There's been a lot of focus on corporate C corporation tax reform, basically lowering the rates and eliminating the deductions. But if that happens, it might change the game. But if they don't do that, the problem with C corporations is still you have the double tax on earnings. And right now that's 44.75%. If you look on earnings of C corporations that are distributed out as dividends. In 2013, that double tax goes up to 60.74%. That's a really high tax to get your earnings out of your C corporation. Additionally, C corporations always face the problem of a double tax on the sale of assets, which pass-through entities do not. And I think the fallout of if these rates come into effect, one other fallout, which will fall in Jane's area, is I think you'll see a lot of increased activity in the unreasonable compensation area, because right now they just have that 15% dividend rate. And when you take into account the self-employment tax or Social Security taxes, the rate difference between a dividend versus wages and where Social Security taxes are imposed isn't that great. But again, if the rates go into effect and the double tax becomes 60.74%, I think you're going to see IRS pursue that. And I just might mention, I think Jane and Charlie have had a number of very successful results in unreasonable compensation cases, and I think we will be seeing those in the future. Few things you might want to consider before rate changes in 2013, just a little planning opportunities. I know a lot of you probably take advantage of 1031-like kind of exchanges. You might want to consider, I know the capital gain rate is only scheduled to go to 20%, but again, there's uncertainty there as to how high it'll go, and I don't think we're going to see anything as low as 15% for a long time. So when you have a piece of property, you might want to think, no, I don't want to do a like-kind exchange. I would rather go ahead and realize the gain or recognize the gain at the 15% rate before it gets to 2013. Now, C corporations don't have that advantage because they don't have a special capital gains rate. So that's only available to pass-through entities. Additionally, if you're going to make a sale before 2013 of property and you're going to receive payment over a number of years, usually you say, well, I want to use the installment sales method and report the income as it comes in over the number of years. Well, you need to do an analysis. It depends how long that period is, but you may very well want to elect out of the installment sales method and take advantage of the lower rate in 2012 or 2011, because when those payments are received under the installment sales method, they're taxed at whatever rate's in effect during that year. Likewise, if you've already had a sale, you're holding an installment sales obligation that you're recognizing income over a period of years, you might want to take some actions to accelerate the income in that installment obligation before 2013, although it's not necessarily that easy to do it. There are some planning opportunities. Finally, for those of you who are S corporations, who were formerly C corporations, so there's a couple of potential taxes or termination problems for those S corporations. One method of eliminating that problem has been to distribute the subchapter C earnings and profits out of the S corporation that used to be a C corporation. And definitely you may want to take a serious look at that before 2013, because again, you have the special 15% dividend rate, which will go away then. With that, I'm going to go over the handout has the advantages and disadvantages of the whole alphabet soup, as I call, of entities, LLCs, LLPs, LPs, LLLPs, S and Cs, and it can get almost confusing, or can get pretty confusing. I will say, since the Tax Reform Act of 1986, pretty much all entities have been formed as pass-through entities if they qualify, or have been converted. A lot of C corporations had converted to S corporation status. And that's because with pass-through entities, you have a single level of tax on your earnings, you have a single level of tax on the sale of assets, and you have the ability to enjoy that preferential capital gains rate of 15%, which C corporations don't. I think what I'll do in the interest of time is to give you kind of just a very broad overview of specific facts and circumstances for choice of entities. And as Michael said, I talk a lot about S corporations, so I might be a little biased in talking about and recommending S corporations. But from my viewpoint, for the operating business, not one that you're just holding land or appreciating property, you're much better off with an S corporation than any other type of entity. You have the single level of tax on earnings on sale of assets. You have a distinct advantage over LLCs and partnerships to minimize Social Security taxes. And as David pointed out, those are going up to 3.8% in 2013. You also have the advantage over partnerships and LLCs to utilize the tax-free reorganization provisions that aren't available to partnerships. So again, for operating businesses, I would normally recommend an S corporation. If you're currently a C corporation, I would seriously consider converting to S corporation status. There's a lot of tax considerations, in particular the built-in gains tax, but we can certainly plan around that, and we've done that for a number of our clients. Now, for real property, just real property you're holding or leasing out, or maybe commercial real property, I will say I would probably go with a limited liability company for your choice of entity. Again, you've had the single level of tax on earnings and on the sale of the assets, but you have much more flexibility with an LLC taxed as a partnership to make special allocations. There's no eligibility requirements as there are in S corporations. You get inside step-up in basis when you transfer an interest or a partner or a member dies. And last but not least, there is the asset protection side, where in Florida, especially with our recent legislative fix, which I imagine our estate planners will be talking about this afternoon, the creditors of members of LLCs can only get a charging order on the LLC interest as opposed to being able to foreclose on stock. So that's an advantage. Lastly, I'll just mention, and probably the estate planners will say this, when you're talking about estate planning, I think the estate planners still favor limited partnerships or limited liability limited partnerships, just for the advantage, if you're going to be doing gifting, to take large discounts for minority discounts and lack of control discounts. Last thing I want to say, and again, about choice of entity, and I'm not sure, again, to the extent you heard Charlie last night, you know there's been a lot of talk. Most of this talk has been, again, focused on C corporations, large C corporations, reducing their rates to make them more competitive internationally, but at the same time eliminating a lot of deductions. Well, that's all good for them, but I can tell you, if I usually go over choice of entity statistics, there are far more pass-through entities in the United States than there are C corporations. And the fallout from that for pass-through entities is they wouldn't be able to enjoy the lower corporate tax rate, and they're going to be losing a lot of deductions. So it could have a substantial adverse impact on small business, in my opinion. With that, I'm going to go ahead and turn it over to Jane. She's going to talk a little bit about worker classification and tax controversies.
Thanks, Steve. I'm going to address for a few minutes an area of potential tax controversy for agricultural companies, and that's in the area of worker classification. And in worker classification, what I mean is that distinction between the independent contractor and the employee. And this overlaps a little bit with our first panel of this morning, talking about the labor rules that may be applicable. So here I'm talking about kind of the same distinction between the classification of workers, but on the tax side instead. If an employee is incorrectly characterized as an independent contractor, a number of things can result on the tax side and create a significant, at least potential liability for the company. First, if the worker is really an employee, there should be income tax withholding. There's also the Social Security tax FICA requirements, and also the FUTA requirements. In agricultural businesses, there's some exemptions for ag labor on on the FICA and the FUTA. There's some sort of nuances of making sure that the correct tax payments are being made for the agricultural workers. But if the workers are incorrectly classified as independent contractors, it could be quite expensive to the employer if the IRS came in and made that attempt to recharacterize the nature of the employment relationship. And that can come up in a couple of ways. It can come up with an employment tax audit, where the company is selected for audit by the IRS, by the Employment Tax Division. It also comes up quite frequently in what's called an SS8 determination. If you have a worker who leaves the company for any number of reasons, they actually have an opportunity to file a form with the IRS and say, my company has treated me as an independent contractor, but I think I'm an employee. And they may make that position because they're trying to get, say, unemployment benefits after losing their position. So that's another way that an audit could be triggered, is with the IRS making this determination with a worker actually coming and asking the IRS to make that decision for them. This topic, there's a number of relief provisions when a company is audited for employment taxes, so that full nightmare of possible tax liabilities in many cases would not apply, because if a company is properly filing forms 1099 to report the amounts paid to the workers, then there are some relief provisions available. But there are actually two new developments in the worker classification area this week. The first one is that the IRS signed a memorandum of understanding with the Department of Labor to exchange information between the two agencies, which again kind of ties back into this morning's panel talking about the Department of Labor and the different wage rules and where that worker classification matters. The second development is on the tax side, on the IRS side. The IRS has just released a voluntary classification settlement program for a company that has independent contractors, for a group or a class of workers, and if the company is concerned about that treatment, the IRS now has a brand new program where you can voluntarily reclassify the workers as employees, so they would remain employees going forward, and pay a very reduced amount, about 1% of the compensation paid to the workers for the prior year. So there's a great opportunity if any of your companies have independent contractors and you're concerned about whether that treatment is correct. And the only other thing to consider is to, just as a planning look, to kind of look at anyone you do have classified as an independent contractor. We have a lot of clients who are quite surprised to learn that groups of people that they would have thought clearly qualified as independent contractors were actually properly characterized as employees. So now's the time to look at those groups of workers that you have classified as independent contractors and make sure that they're correctly classified. And if they're not, or if they're in a gray area, you might want to take advantage of this voluntary compliance program.
Thank you, Jane. That was very good in a very short period of time. Before I move to Jesse, I did just want to mention, again, Jane is very heavily involved in tax controversy, as well as Charlie Edgerton and a number of other attorneys in our office. But Jane and Charlie just had the recent distinction of having a major victory in the tax court on a very big case that they got a lot of publicity on. I don't know if you want to say anything about it, Jane, or...
That was the case for the estate of lay in the tax court, and it was an issue. It was not an agricultural issue. It was involving the sale of annuities, but we were able to have a complete win in the tax court on that case.
And any win you can get under Enron facts is a darn good win. So go ahead, Jesse. I'll turn it over to you for conservation easements.
All right, conservation easements. I'm going to, in the interest of keeping on schedule here, I'm just going to kind of go through the highlights of my notes here, and hopefully it'll give you kind of a general overview of the tax implications of conservation easements. So conservation easements might make sense for landowners who are interested in reducing income and inheritance tax and who are also willing to restrict the future use of their property in some way, whether that be to prevent future residential or commercial development or to allow for some other type of restriction. And it's a cost-effective way for government agencies or other conservation groups to protect land. So basically, a conservation easement's a voluntary, legally binding agreement between the landowner and the conservation group. It's customized to meet the goals of both parties, and it's typically perpetual in nature. In Florida, the perpetual conservation easement can take the form of it can either be a donation or a sale, and the sale price can be as much as the difference between the fair market value of the property unencumbered and the fair market value of the property after the conservation easement is agreed to. From a tax standpoint, there are income tax implications, both state and federal, transfer tax implications, both state and federal, and property tax implications. Obviously, in Florida, we don't have state income or estate tax, so I'm just going to focus on Florida. The state laws of all the other states vary pretty widely, so depending on which state you're in, you'd have to look at the state laws there. But in Florida, we only have property tax implications. For tax benefits resulting from a conservation easement, for federal income tax purposes, the tax benefits are only allowed for qualified conservation contributions, and that's defined under Section 170H of the Internal Revenue Code. And for a transaction to be a qualified conservation contribution, the easement must be made to a qualified conservation organization, which there's a list of those maintained by the IRS. In Florida, the major state agencies which are involved with conservation easements are the Department of Environmental Protection and the water management districts. They're particularly interested in protecting watersheds, which I think was mentioned and talked about earlier. From a gift tax perspective, the Pension Protection Act of 2006, which was extended through 2011, provides that a donor can deduct up to 50% of their adjusted gross income for conservation easements, and qualifying farmers and ranchers can deduct up to 100% of their adjusted gross income. A qualified farmer or rancher is a taxpayer whose gross income is greater than 50% from farming activities. From a property tax standpoint, the Florida statutes provide that land dedicated in perpetuity for conservation purposes and that is used exclusively for conservation purposes is exempt from ad valorem taxation. Application for that exemption would be made with the county property appraiser's offices, depending on where the conservation easement takes place. From an estate tax standpoint, the most direct implications of a conservation easement is obviously the reduction in the fair market value of the property that's included in the estate of a decedent. There's also additional benefits that can be achieved where there's a charitable contribution of a conservation easement. The Internal Revenue Code allows for up to a 40% exclusion of the value of the property encumbered by the easement, with a maximum limit of $500,000. So, just to wrap it up, there's basically a landowner can talk to their advisors and figure out what the tax advantages of a conservation easement are. But since it's granted in perpetuity, I highlighted a few important questions that someone should think about before entering into a conservation easement. What resources do you and the conservation entity want to protect on the property? What activities does the landowner and the conservation entity want to prohibit on the land now and in the future? What activities does the landowner want to continue on the land? Is the landowner willing to convey the rights as required by the agreement that's entered into? And what other activities, in addition to those taking place currently, might the landowner and the landowner's heirs want to do in the future, which are compatible with the easement and the grantee's conservation objectives? So with that, I'll wrap it up, and I'll be available afterward for questions.
Thank you, Jesse. I just want to take, I know we're kind of out of time, but I'll take a couple of minutes, hopefully, to wrap it up. First of all, I'd like to say I know Michael and our other partners have done a lot of work in the conservation easement area. There's a lot of opportunity, and just to put another plug for S corporations, they used to have a limitation. No, well, it's important because it's timely. You used to be limited to your basis when you made a charitable contribution, but you're not, at least through 2011. That was part of the extenders bill. All right, in the last few minutes, I just wanted to point out some different strategies for minimizing or deferring gain when, as I say, disaster strikes your business. The materials in the outline really focus on citrus canker. It could be hurricanes. It could be, I know a number of years ago, I handled a number of cases for fern growers where DuPont's Benlate destroyed everything. And from a tax perspective, what happens is they'll get payments. You're getting payments from a government agency such as the USDA, or maybe from an insurance company, or again, maybe from a third party like DuPont where they've caused damage. And the question is, how do you minimize or defer gain on those monies? Because the IRS will come in many times and try, of course, they want to say it's all ordinary income and all immediately taxable. And I'm just going to, again, hit this very briefly. So your first issue really is, did you receive the payments for lost profits versus destruction of property. Sometimes that's delineated in the orders, sometimes it's not. Like in the Ben Lake cases, it was, you had a bunch of personal injury attorney that got the judgments, but they didn't have anything delineated either way. So you had a lot of freedom to argue what was for what. And what's the importance of that? Well, obviously, if it's for lost profits, it's ordinary income. If it's for destruction of property, you can take the position that might be return of capital, or two, you get capital gains treatment on it. So that is very important in how you characterize it. Additionally, if it's for destruction of property, you may be able to defer the gain by reinvesting the proceeds under the involuntary conversion provisions of Section 1033 if you reinvest in property similar or related in service or use or like-kind property in the case of real property. So again, to the extent you do have lost profits, you can use Section 1301 for income averaging to minimize the impact of that. As I just pointed out, you can argue it's destruction of property, capital gains, and potentially use 1033 to defer your gain until you dispose of the replacement property. And lastly, there 263A, although it normally requires you to capitalize cost, it does provide an incentive for growers to replant the same type of fruit where you can expense that. So just a couple of things to keep in mind. I'd like to thank the panelists and thank you all for your attention.